I'm Gideon Pfeffer. I'm the CEO and managing partner of the GSH Group. We're a multifamily owner-operator sponsor headquartered here in Michigan, in Clawson, actually. A little bit about us is over the last 5 years, we've acquired about 7,400 multifamily units and placed about $300 million of investor equity across 5 states. And I'm going to let my distinguished panelists introduce themselves, starting on my right with Milco.
Hi, how are you guys? My name is Milco Cipriani, and I am the managing partner at Hyde Park Commercial. We are a privately owned investment firm based in Houston, Texas, and we focus on acquiring and developing industrial service facilities and industrial outdoor storage facilities in Houston and other Texas markets that have access to seaports and intermodal facilities.
Hi guys, I'm Alex Epstein. I'm a part of the investment banking team at Lex Markets. We're a real estate investment bank where for all owners and sponsors of real estate, we provide permanent non-voting capital at market prices to come and fill in your capital stack. And we make that capital accessible to everyone, family offices, institutions, as well as retail through our process of IPOing individual assets. Oh, I'm sorry. There we go. Sorry if you couldn't hear me there. I'm getting used to the mic. Yeah, we IPO individual real estate assets and provide permanent non-voting market price capital to real estate sponsors and provide accessibility to institutional grade real estate to family offices, individuals, and everyone across the board. Yeah.
Good morning, everybody. I'm Scott Goodman. I'm a founding principal of Farpoint Development in Chicago. We also have an office in Asheville, North Carolina. Down in the southeast, we focus primarily on multifamily and industrial. And out of our Chicago office, we're pretty agnostic from an asset class perspective. Our biggest project is a 100-acre development we're doing on the lakefront in Chicago, which will be completely mixed use, focused on social impact, life sciences, and those things that really are determined by the social determinants of health, which is a longer discussion, but it's going to be a completely mixed-use community which will really be impactful in the city.
My name is Will Mack, and I sell term life insurance. Term life insurance is a very important product. It's a pathway to the middle class. We shouldn't pick on the term life insurance people. Will Mack, first of all, thank you, Lynn, for having me, for having us, for putting all this together. This is great. I'm a securities regulatory lawyer. I'm always pleased when I say that to people and they don't fall asleep before I get done with it. I think what I do is important. My kids don't. I help put together broker-dealers and exchanges. Think of me as the distribution part of any real estate project. That is getting securities into the hands of LPs or LLC holders. Work with Lynn frequently, work with a lot of different real estate developers, intermediaries, and issuers of securities.
Awesome. Thanks, gentlemen. I appreciate it. And I'm excited to talk about real estate, and we have some things that we talked about this past week on our prep call that we'll have a little conversation up here about, and then I'm going to open up the floor to questions that others might have about what's going on in the real estate world right now. I think that the topic or the title of this panel has to do with investing in real estate in an inflationary environment. But real estate, as John mentioned, is a tool and an amazing tool to create generational wealth. Whether a family's wealth was built on real estate, which is often the case, or preserved through real estate is often the case. And there's so much different ways to invest in real estate. There's a few up here that we'll talk about. But something that's important for, I think, us as well as those of us on stage, as well as those of you in the audience. And I'm always trying to think about, who is the audience and what are we doing up here, right? So if it's a conference that's geared towards family offices or folks who facilitate investment for family offices, we've got real estate folks up here that like to invest money, right? So, I know that speaking for myself, up higher, thank you. I'm hearing like a little twinge, so I was worried that perhaps I was speaking too loud. But coming to a family office conference, my goal is always to meet as many individuals from family offices that there are, right, and see if there's a fit between their goals and mine. So I'm not going to be coy on stage about that fact that there could be a pairing. The purpose of coming to conferences is to learn, exchange information, as well as perhaps network and get some contacts from one another. So if there's anybody on stage here that that seems to be a fit for you, please don't hesitate to get up after the panel, exchange a business card and whatnot. So investing in real estate in inflationary times, right? I want to focus on opportunity, but let's talk about some headwinds that we're facing right now. So Milco, starting with you, how has your business changed? What did your business look like in 2021, and how has inflation and rising interest rate and that environment affected or impacted your business, today, maybe from perhaps in a negative way or maybe in an opportunistic way as well?
Yeah, absolutely. So just to answer your question as directly as possible, interest rates in 2021 were 4% for us on average, and right now it's 7 to 7.5%. So big difference there to start, but more than that, it's the uncertainty and other things that we have to pay attention to as far as being able to get fixed debt, having a decent amount of reserves and deals now to where before we didn't have to carry such a large reserve in our underwriting. Besides that, the uncertainty that there is in logistics as well, just because of COVID and everything that's going on there. At first it seemed like, rents kept going up and pricing for shipping kept going up, and now it's starting to level out while interest rates continue to climb. So it's definitely affected us in that way to where we need to be a bit more careful about the things that we're looking for and, pay attention to potential speed bumps or more headwinds coming up the road in this uncertain market.
So in industrial storage, right?
Yes.
So that includes indoor and outdoor storage facilities?
Correct. So mainly it'll be what we call stabilized yards, which are big, 5 or 10 acre plus tracts of land that are mainly used to store containers coming in from ports, bulk material storage for construction entities. They're also used for truck repair, tire shops, and mainly for transportation companies to store their fleet of trucks as well. And during COVID, everyone goes indoors, supply chain gets disrupted with China's zero COVID policy, and that created a lot of demand for this type of product specifically. And that's when we saw a very continuous uptick in rents, and now it's still there, but we're treading carefully. And to finish answering your question, yes, some of them do have a building on it, but some don't.
Awesome. All right, Alex, same question. What did your business look like in 2021, and what does it look like today because of inflation?
Yeah, it's changed a lot, right? So Lex Markets, we have to sit right in this precarious place between real estate sponsors and investors, right? Where we need to create an investment product that people want to actually buy that's great for your portfolio, and also be a partner to and serve real estate investor clients. And I think in today's market with inflation, you've seen commercial real estate enter this very sort of interesting place of price discovery that we're really on the forefront of, right? Gideon, you and I spoke earlier, in a low rate environment, it's easy for everyone to be a winner in commercial real estate. In today's world, not everyone's a winner. And so my job has gotten harder in not only finding good deals, but in creating good deals and working with sponsors to find that sort of correct price where the investor is not getting fleeced and the sponsor is getting what they need out of the deal. And having to have those tough conversations of, we're not in an environment where cap rates are guaranteed to compress. In fact, they're probably going to expand, right? The Fed's raising rates. It's getting harder and harder to go and finance real estate deals with debt. And you are seeing, it's sort of a very interesting place with regards to pricing. It's also interesting because we're having people being driven to us by these rising rates. As people need to refi and restructure their capital stacks, there's an increased need for equity like ours that can come in and be secure, permanent equity and just move around the capital stack to take out some of that debt. So there is business being driven in. And it's a really interesting place to be to go negotiate that fine line between serving the best interests of our investors, be it family offices or retail, and really being a trusted partner and on the side of the sponsor as well.
Scott, how about you?
Great news. Interest rates are up, price of construction. And the truth is for us, we love these markets. This is the time that we've historically created more value. Some of the competition has gone away in the market. This is kind of flushing out some of the, when the doctors and lawyers start getting into the real estate development market, that's when we know it's time to sell. And now that we kind of see that, interest rates were artificially low for a long time. That wasn't a sustainable level. We have expected this to be coming for a while. The pandemic, this really disrupted the supply chain. That's going to straighten itself out in the next couple of years. So, a year ago or 2 years ago, really, we thought it was really hard to do business. And we think with the way the market is adjusting now, we see what's happening in the stock market, this is a fantastic time to be doing more real estate development, we think. And we are seeing more opportunities now. We do, not to use the same term again, but we are finding deals and we focus on qualified opportunity zones. We feel like we have one of the best ones in the nation in Chicago. We have a 100-acre site that we're going to be developing on the lake, which is Opportunity Zone, a mile and a half from downtown. That shouldn't be available to develop in 2023. The things we're doing in the southeast, same kind of idea. The competition is falling away. The best deals are yet to be had, we think, and we're pretty excited about these times. Inflation, great time to be in real estate.
I love that perspective.
Yeah. I'm a lawyer and my wife's a doctor, and we were thinking of getting into some real estate development.
And he sells life insurance.
Right. Yes. Whatever you need, I've got you covered. But Scott convinced me this is not the time for us. So I think what we're going to see is, with debt becoming more expensive, a continued push toward equity. And I think folks are going to be looking for more and more sources of equity, and institutional equity isn't going to cover it. So you're going to see more folks looking to retail equity in the capital markets and going direct to investors. And fortunately, that's what I do. So it could be a good time. It's always a good time for the lawyers, but it could continue to be a good time for folks. Yeah, see, there we go. I think we're going to see more of that.
Will, what are you seeing? Are you seeing anything changing from your client base, or is that kind of what you're talking about in that comment? Can you expand a little bit more about institutional capital going away and needing to focus on retail, and maybe define those terms for the audience so they can get an understanding of where you're coming from?
So institutional capital is your large life insurance companies, large banks, occasionally hedge funds that will put large blocks of equity into deals, right? Sometimes these are called direct deals. New York Life, for example, will partner with a developer, give that developer a $100 million check and say, okay, we're in this long term, just bring us 7% a year for the next 7 years. Retail is a little different. Retail can be, accredited investors, anyone who has $200,000 or more in income each year, investing directly in the deal. And these are done often through websites, pursuant to an exemption from securities registration called 506C. These are your realty moguls, your Crowd Streets, or a lot of issuers, say like Ashcroft, will just set up their own site. And you can go right on their site, become an LP holder, put it as little as, sometimes the ticket sizes are as small as $25,000. Other folks, I think you guys will go far lower.
We go as low as $250. $250.
Right.
Sorry, $250. And I'll come back in a minute, but we're actually a little bit different in a way I want to speak about versus those 506Cs in terms of the investment product to everybody.
Yep, that's right. And what I was saying is I think there'll be a move toward more retail as investors, as institutional investors seek other places to put money for the time being to diversify.
All right, so let's do a little know your audience exercise, right? And raise your hand if you ever invested in real estate, including owning a house. Okay, so now I see all your hands work, your arms work. Okay. Who has invested in real estate that's not their house? Who's invested in real estate on their own without a sponsor? Who's invested in real estate with a sponsor? Who's invested through a platform that Will was talking about, like a crowdfunding platform, like Realty Shares back in the day, Realty Mogul? Who has a trusted sponsor that they just follow in every single deal that they put out? Okay. So we're all pretty familiar with opportunistic investments. Then, and who's investing for cash flow? Who's investing for upside IRR? Who's investing for tax advantages like accelerated depreciation? Who doesn't know what accelerated depreciation is? It's okay. Don't be shy. We want to educate. Okay, cool. Everybody knows. All right. Alex, you were talking about something interesting as it relates to Lex and the democratization of investing. So why don't you expand on that?
Yeah, so Will was mentioning how there are now platforms, websites out there that allow people to invest directly into real estate in much smaller chunks, generally through Reg D. You need to be an accredited investor. And those investments, typically you come in as a part of the capital structure as an LP. You're subject to a promote and a performance fee. It's a great deal for the guys who are running the deal because they get to charge a bunch of fees off of you. And then your capital is locked up, right? Just like how it would be if you were investing on your own, but now you have a much smaller chunk and it's all locked up. What Lex has done is we've been able to actually take that same benefit that Gideon was speaking of, and we all just raised our hands for, accelerated depreciation, tax benefits, cash flow, IRR. We've been able to bring all those same properties through to investors. And we do have an online platform, but we've actually structured our securities a little bit differently, where it's run a lot like an actual IPO. We file with the SEC, and it comes out looking like a stock. It can sit in your brokerage account, it can sit in your TD Ameritrade, and it can trade, right? You're not locked up for 5 years. You're not beholden to the sponsor. You're not subject to promotes and performance fees. You're sitting alongside the GP. We come in, the GP is able to realize their promote from whatever capital structure was previously in place, and now you get to go and sit pari passu along with them. So you have better economics than you would normally have access to. You're in all the same institutional real estate deals, maybe even better deals, thanks to our wonderful managing director, Kareem, out there, and his depth of experience and connections in the industry. And now you have a stock that you can trade. And so it's not meant to be a day trading piece. It's not like you're trying to go and be a Robinhood trader. But this is something where if you want to manage your portfolio and you say, I want to go and sell down this real estate and pay for my kids' college. I thought I'd be in this deal for 5 years. I want to be in for 3. Now you have the option to trade out whenever you'd like on an open marketplace that we've created. We actually built an alternative trading system. Think one level below a stock exchange in partnership with NASDAQ that allows you to trade in and out with your brokerage account with a DTCC eligible QSIP security that represents your partnership interest in real estate.
Yeah, that's really, I think, cutting edge as it relates to how investors can get access not only to real estate deals, but also get access to secondary market liquidity, right? Meaning being able to get their investment out before the deal is sold.
Absolutely. It's a completely unique product. We're very proud to be the first ones to bring this particular thing to market. There are things similar. We mentioned CrowdStreet and Realty Mogul. The idea of being able to invest small chunks in real estate is not new. The ability to trade in and out as you'd like and do it in smaller and smaller chunks and sit pari passu along with a sponsor, all of that is new. And I think we are very proud to be on the forefront of democratizing real estate. And I'm going to preempt the question before we get there, but we frequently get compared to blockchain solutions and tokenization, right? And I think we're also proud to be differentiated from that. Not that blockchain is bad or tokenization is bad, but we've taken a traditional rules-first approach, right? We've looked at the existing playbook and we've said, how can we maximize the rules that are in place and not run into trouble to have an institutional-friendly product that no one needs to be afraid of, that they can go invest in and still have all these benefits.
So I want to shift our conversation shortly to social impact and ESG, but I want to jump back over to Will, because you're shaking your head a lot as it relates to secondary market liquidity, tokenization, what Lex is doing, what the crowdfunding platforms are doing. You know, what's your take on that?
So I think what Lex is doing is absolutely unique and totally clever at the same time. It's the rare instance where there's been a true innovation in the industry. A lot of what you see, a lot of innovation is simply rediscovering old things, right? And you mentioned the blockchain and NFTs, and that's largely what that is. I, as a securities regulatory attorney, I'm kind of an idea funnel, right? I get entrepreneurs and people who want to start things. They come to me and they pitch their ideas, and I tell them, you know, this is illegal, this is not illegal, essentially. And the idea I got thrown at me from February to, say, May, twice a week was, well, I want to put real estate on an NFT. And, you know, NFTs are great. Think of an NFT, non-fungible token, as the receipt for ownership of a thing. What was lost in those conversations and what these people generally didn't realize is just because you put it on an NFT doesn't make it stop being a security. And it's absolutely a security, and therefore all the same rules apply. It's just that LP interest you were selling anyway. And it's no more transferable now because it's on an NFT than it was before. And if that NFT goes on an exchange and it is transferred, that exchange is operating as an illegal securities exchange. It's violating the 34 Act. It's a solution. But what you guys have created is that solution without the gloss and the fanciness of the NFTs. And that brings it back to what we were here to talk about, which is safety and security. I think, you know, NFTs have glitz and blockchain has glitz and glamour. Doesn't necessarily change the business we're in. Functionally, doesn't solve a problem, doesn't solve a securities law problem at all. And so to find security and find safety, we need to avoid the novelty items, the things that are hot now but won't be in the long term. For the moment, that's NFTs. As to a secondary market, other folks have tried the secondary market. The secondary market is the secondary market for private securities is the holy grail of the securities industry. No one has achieved it with liquidity, with real liquidity. I think what you've done is probably the best attempt so far.
Yeah, you know, again, I'm very proud of what we've created. We created, like I said, an alternative trading system. So one level below a national stock exchange. There are about 30 of them that exist in the country, right? It's a very, very difficult process. It took us, 4+ years to build out, like I said, in partnership with NASDAQ, a very complicated endeavor. And there are two really great parts about what we've done that I think have that potential to be a real solution. One is by being our own ATS, we get to write our own rules for the exchange, right? So NASDAQ can't come and say, oh, hey, this building's too small. Oh, we don't want to operate in Alaska, right? All of those decisions are left to us, and we're able to use our investment discretion as to what belongs on our exchange and create a real democratic marketplace for all of that. The second part is by structuring it in this way, it's fully compatible with the existing financial system. So not just sit in your brokerage account, not just be tradable on OTC markets or whatever you'd like, but these are actually eligible for things like ETFs, right? These consider mutual funds. As we scale and as we hit trading volumes, this has a ton of potential to be integrated into the broader financial system. And it does take, as Will said, it does take building that momentum. It takes volume. It takes people coming on. But we're already seeing uptick, and as we do more deals and bring on new investors, we become eligible for more and more, and it's an exponential growth of liquidity. And we hope to one day, hopefully quite soon, be that secondary market solution. I think we're very well equipped to go do that.
Thanks, Alex. Scott, let's talk about what you're doing in Chicago. You mentioned a 100-acre site on the water, and you also talked about a healthy community. Can you tell us a little bit more about this big project that you're being modest about and the vision behind that?
Sure, thanks. So we in Chicago, there's a piece of property that was the Olympic Village for the 2016 Olympics, which were really fantastic. And, oh wait, we didn't get those. So there's a piece of property that the city got left with, which again was right next to our convention center, McCormick Place, on the lake. That we were awarded the RFP. We tell the story frequently that I was born in Evanston, Illinois. My life expectancy is literally 30 years more than if I was born in the impoverished South Side. So, and that's not gun violence. That's things that we call the social determinants of health, which are access to good jobs, good living facilities, good food, good education, good mobility, good transportation, all those things and more. And we're addressing all those on this site, and much of the social impact and social equity and health equity is being addressed through things similar to what we're talking about. We will be offering community to build wealth on our site through different vehicles, one of which might be a tokenization, but some other, we have, it's a much longer discussion. I don't want to just monopolize the panel here too much, but this will be a 15-year project. We're starting out with a life science building. We've partnered with the 10th best hospital in the world, which is called Sheba Medical out of Israel, to bring in global startups to Chicago, which will be addressing these problems, these social impact problems. We will be an entirely mixed-use community of multifamily, retail, office, life science, open space, and many other asset classes. As we get going here, and really, it's such a long discussion, and I appreciate the forum to do it. But really, BrownsvilleLakefront.com. It's going to be transformational to the city. We've made a great deal of commitments both to MBEs, minority business enterprises, and WBEs, women-owned organizations. We have promised 30% of that to go to those, but we're endeavoring for more like 65%. We are offering all types of job training and apprenticeships and internships throughout the site. It's really very comprehensive. We are just about to break ground with our infrastructure. Something else I should just mention, it'll be completely carbon neutral. It'll also be its own smart grid. We've brought in somebody a guy named Jason McLennan, who just built Climate Pledge Arena in Seattle with Jeff Bezos. That's the first carbon neutral sports arena in the world. He's our godfather in mentoring us through this entire project. So we think we are hitting every food group that's really relevant in this day of development. We're excited by it, and again, I could talk for hours, and I don't want to do that.
It really sounds amazing. Are you able to share what the total? It sounds expensive, right? What's the total capitalization do you estimate over the next 15 years, or do you not want to say?
No, actually, we were lucky. We got a Groupon, so it's half off. No.
All right,
so we're looking for about $4 billion worth of investment.
Okay. That includes debt?
That includes debt and equity.
Okay.
That's correct. About $1 billion in equity, or a little more. It is a qualified opportunity zone. Again, in this market, and we're talking about security and investment in real estate right now, and I mentioned how we get excited by these types of markets because we really believe that you're able to cherry pick a little bit more and really add value. As a company, the idea of an IRR investment, we think is great for the developer, not necessarily as good for the investor. So we talk more in terms of multiple on invested capital as opposed to IRR. We take a little longer term perspective, and especially because it's a qualified opportunity zone, you do have the 10-year benchmark that you have to reach. So we think this is really an amazing investment. Our basis is lakefront property, really anywhere in the world, but here in Chicago, we're paying $32 a foot, which may or may not mean things to people here, but that is really a fraction of what we think the value is worth. So the value creation on this property, we think is fantastic and really a rare opportunity.
So on a $4 billion project in prime real estate in Chicago, sometimes that could feel like out of a normal investor's reach. if I've got $250,000 or more that I want to invest, is there an opportunity to get involved in this project?
Yeah, absolutely. Yes.
All right. What was the website again?
BronzevilleLakefront.com.
Got it. Okay. And who here is not familiar with the tax benefits of an opportunity zone, or like has heard about it but is like kind of like, I'm not really sure. Okay. Will, you're the attorney. You don't want to do it?
Not a tax attorney.
All right. Well, I'm not an expert, but the basis is that if you have a capital gain, let's say this year, and you invest in a qualified opportunity zone, you can defer that gain for a period of time, and you can also defer or not pay gains on the realized profit of the new project that you invested in, as long as that investment is made for 10 years or more.
Can I try that?
Yeah, you go.
So basically, if you take a capital gain investment, put it into a qualified opportunity zone investment, hold that investment for 10 years, whatever value is created, if you put $1 in and that value becomes $10, that $9 of gain is all tax excused. There's a 100% step up in basis after 10 years if you hold that investment. It's an amazing tool for capital gains investors.
So you've got this amazing retail project on the water, state of the art, social impact, green, everything, ticks every box, and it's in an opportunity zone.
Yeah.
Nice work on that.
I want to give you one word answer. Yes.
Okay, great.
You asked not to do those.
Milco, we've given the other three an opportunity to kind of showcase what exactly they're working on. So tell us about industrial. I mean, I know that, well, I don't know for sure, but it seems my perception being a multifamily guy is that industrial has been a great market to be in, a great investment opportunity for not only investors but owners. But there's been hair at times with supply chain issues, and but has it slowed? Is it going to continue to grow? Like what do you see on the horizon for that specific type of investment that you're involved in?
So for starters, I wanted to shine a little bit more light on what an industrial service facility is, or industrial outdoor storage, and we are facilities that complement and support the e-commerce supply chain. So think of us as the facilities where after you buy something from Amazon or Walmart or whatever the case may be, it gets put most likely from China, gets on a boat and gets brought to a U.S. port. When it gets to the port and offloaded from the boat, it gets trucked to a nearby site, not always to the warehouse directly, but to a site that's an intermediary between the seaport or the intermodal facility, which is going to be railroad, and the actual warehouse, the distribution warehouse. So we are that facility, and that's the reason we are so important right now, because with all of the supply chain disruptions, I'm sure you guys read about, the 60-mile long backup at the LA port. So when that's going on and you're having to pay a premium for keeping your containers at the port, we serve as a alternative where you can actually rent out a facility for a period of time, place all your goods and then sort through those as need be, and alleviate the supply chain and make it easier for the consumer as well. So, that's what we focus on, and how it's changed lately. We've been focusing, especially, with sticking with the theme of security, in three main buckets, and those have been, we look for sites that are, predictable in the sense where we want to know very well what type of tenant we're going to get in that site, where you can predict rent in a very confident, with a very high degree of confidence. And also, more than that, location as well would be the second bucket. I think, in downturns and in inflationary times, there's nothing that's going to replace the location of your real estate, and that's ever important in today's world. And thirdly, investing in something where tenants need it and it's more of a need than a want. And right now, these facilities are definitely in need. As many of you know, there's been a lot of talk about, a railroad strike. There's also a shortage in truck drivers, and that's actually created a lot of disruption in the supply chain, which has actually benefited us. And there's more stuff to store, and it's not moving as fast as before. So, yeah, definitely a great time to be in it. I'm very bullish about the future. Of course, treading with caution, but yep.
Awesome. Thank you. All right, we've got about 10 minutes left, and there's so much different types of real estate out there. I wanted to open up, give you an opportunity to ask any questions about anything, about a specific real estate sector or investing or anything that might be, if anybody has anything that's come to mind. Yeah. Looking for advice on financing undeveloped land.
Don't do it. Really, putting debt on vacant land to me is a pretty risky thing. You don't want to have that gun to your head because you don't know how long it's going to be till you're able to develop it.
So and there's probably few institutions out there that'll do it, which I'm assuming is why you're asking the question, because you're having a hard time finding it. I think that the next thing on the agenda is like growth versus opportunity, right? And I'll be talking about that. And I think that patient money is the opportunity. And the point of me saying that is that it's a JV. I think if there's a vision for the land, if there's it's a great opportunity, there should probably be someone who can write a check out there for as a short-term or long-term type of investor, and that might be the way to go as opposed to debt, even though you got to give away something. But to Scott's point, not having to write that check every month might also make sense, right? Any other questions? Good question. Any other questions?
And I'll just say one more thing: is the whole trick to that land that you're considering is the basis on it, and if you, depending on how you would finance that, I would think that there would be some negative drag that goes with it, right? The basis will continue to go up over time, and because you just don't know the timing of when you'll develop it, it's a pretty risky. Be careful about how you whatever juice you put on that thing.
And before we move, so to clarify, Lex does not do these deals, but my previous job, I actually had looked at a few of these and had done a couple of these. And there were sort of two elements I'd sort of advise, right? Which is one, it's much easier as a lender to lend on land that's been permitted or has a very clear path to permitting than unpermitted land. Getting the permits and figuring out the architectural plans and all of that of what you want to build is one of the largest causes of delay, and time is money when you're financing undeveloped land. The second part of it is, and this is a risky endeavor, but it's how we used to structure these, is capitalizing the interest, right? So if you don't have to write that check every month, if you can go and accrue it, and you can come in with a low enough debt basis where the overall value of the debt with your projected capitalized interest is still reasonable, that's sort of an optimal way to do it. But you're still betting on yourself and betting on things out of your control of being able to get that land permitted and ready to go and people being shovel ready and building so you're able to refi. Especially in today's world where refinancing is a huge question mark, it's definitely a very risky move. Thank you.
Thank you. That was some great insight. I like that. Any other questions before I do kind of a wrap up with the panel?
Thank you. I had a question. I wanted to find out whether the developers up there think that the money is getting more expensive on the equity side now that we have inflation, and whether you've seen it in your deals the last few months. Thank you.
Is it getting more? Is that the question?
I'm asking whether, the
equity is getting more
equity
expensive.
is getting more expensive.
Go ahead. You want me to go? I don't think that equity is getting more expensive. Well, in my world, if anything, I think equity is getting less expensive because cap rates are going up and deals are getting thinner. And so investors are willing. Now, this is just me. I live in the multifamily space, but and I think that there's a risk profile associated with the cost of equity capital. But multifamily is considered, if not one of the darlings, if not the darling of the real estate space. Everybody needs a home. There's a shortage of units, and so investors are willing to take less of a return to continue to invest in it. But that's just my experience.
Yeah, we're seeing something similar even in different asset classes. I think you're always looking at alternative places to put your money, right? And real estate is a really interesting place to put it today. So we're seeing the same thing with even given cap rate compression. We're not seeing more expensive money. It's a little more discerning now, right? Everybody is really, it's not quite as, the liquidity has dried up a bit, but the money that's out there is still very competitive.
Any other questions? Well, we're pushing just a couple minutes before we're supposed to be done. Scott, you started off with opportunities like, wow, high inflationary period. This is a great opportunity. Give me your last comments on that, and then I'll go over to Will and come down the line in terms of what opportunities are we going to get out of the current market environment.
Listen, we're in a business that is always, you have to believe your numbers. That's, if you're fooling yourself, you're just fooling yourself. And so it's always a time for caution. It's always a time for scrutiny of your numbers. But when there's fewer people chasing the deals, that's good for us. And we are finding that where we used to go up against, it might be a dozen people looking for a particular deal, now it's us and another guy, and that creates more opportunities for us.
Will, in your world?
We're going to see a shakeout of the doctors and lawyers, essentially. In my world, I'm largely agnostic, right? I'm here in bad markets. I'm here in good markets. You're always going to need an Exchange Act lawyer. But what I am seeing is the same is what you said, the flight to quality, as the investment advisors call it. The very best deal sponsors are going to continue to raise capital, no problem, but it will be harder for folks lower on the totem pole.
So I think what Will just said has been the traditional knowledge of, in these kinds of markets, the most connected, the best sponsors get access to the best deals. They're the ones who make the biggest returns in these markets. And that's sort of the way that it's been for decades. And at Lex, we would love to go and change it in this cycle. We're trying to be that bridge between institutional and non-institutional capital. So if we're able to go and play in those markets, and we are, and find those best deals and make them accessible where instead of doctors and lawyers going out and gambling on their own, they can come to us and still participate so they don't have to be totally washed out of the process. We're hoping we can bring along the doctors and the lawyers and the software engineers and everyone in this room, individuals, institutions, family offices, everyone can go and participate in this ride of finding the right real estate in this cycle.
Yeah, I definitely agree with everyone up here on the panel. I think, it's a great time to invest in real estate. Definitely a lot of opportunity out there now that there's not as much competition. And I also believe that being a subject matter expert in your specific asset class, such as Gideon in multifamily, myself in industrial, actually plays a really big role because that helps you identify opportunities that other people, such as doctors and lawyers, might not be able to.
Life insurance salespersons.
But I think there's a lot of opportunity there, and also thinking about the long-term plan of these projects, where it's a short down cycle, and then on the ride back up, we can still hold the property and create a lot of value. And I think as Alex said, good sponsors tend to do the best in these times.
Yeah, and I think the only thing that I would add is that as interest rates go up, especially with folks who got aggressive and got into short-term floating rate mortgages, there's going to be some pain, right? There's going to be some pain out there. There's going to be some people who need to sell, maybe have to sell. And while I don't wish pain on anyone, including myself, there's always opportunity. I went to Omaha this year as a guest of Berkadia and heard Warren Buffett speak, and he has a quote that's like, every 8 to 10 years, dark clouds circle and cover the financial world, and for a very brief moment, they part and it rains gold, right? So I'm just waiting for them to part with my bucket, my little bucket, my little piece, but we'll find it as it comes. But anyway, we're out of time. I want to thank my fellow panelists here for a great panel. Thank you.